In terms of the magnitude, so far we got a pullback from here to here. Let's use this price range from the top until yesterday, roughly around 9.8%, let's say 10%. 10% down move. Let's just compare this. If we use this, that's 9%, that's bigger. It dropped more than the previous reaction. Although in terms of wave, it looks a lot larger. But in terms of this magnitude, it's sort of like 9.8% versus 9.1%. But certainly it's a lot better than this. We did not have this kind of the drop yet. This is quite important. In terms of the magnitude, if we compare this is terrible, 16%. And that is another drop, 10, 11, 12%. A lot lesser than that. Here to here, about 16. It's not comparable. You can see that during the downtrend or bear market, the drop is a lot sharper. We got more than 10%. The lowest is about 12%, 11.8%, 15, 16%. That is quite a norm. But during a pullback, 9%, 10% is about it. That's the maximum. Even if we get, let's compare this here to here, this is also less than 9%. By far, this is the largest pullback that's the S&P experiencing since the uptrend in this year. Previously, during the downtrend, we got a drop of 16%, drop of 12%, drop of 16%. That is different. This is during a downtrend, during a bear market. And if we look at the volatility, how's the volatility during this pullback? It's very similar to here or here. They have the similar volatility. And if we compare to this sort of the down move, okay, let's use another color. Let's use blue here. This is the down move during the downtrend, during the bear market. What do we see here? This is a lot sharper and a lot stronger. Look at all these big candles. Sharp candle, gap down, huge spread, acceleration to the downside, acceleration to the downside, big spread bar, bearish bar, and it's a lot more impulsive. But if we look at the current pullback, this is not that impulsive. And in terms of the spread, the bearish spread is not as big as the previous spread. It's a lot more look like here. This is the bearish spread that's very similar to the current pullback. You say the down waves now are more prolonged. Yeah, absolutely. This is another good point. In terms of the time aspect, since August, topping is August until now, end of October, August, September, October, roughly close to 3 months. It takes 3 months to drop about close to 10%. Wow. If we look at the time or the date range from here to the lowest point, this is 40 bars, 57 days. So yeah, it's actually 2 months. This is relatively bullish than the previous down wave in terms of the time frame. It takes longer to drop lesser. In terms of the magnitude, it's not as sharp as the previous down wave. And in terms of the volatility, it's not as impulsive as the previous down wave as well. And in fact, it looks a lot more like this down wave, this sort of a consolidation, but this is consolidation, not a down wave. Right now, I still classify this as a pullback or a healthy pullback. It's a frustrating pullback because the only thing that's prompt a red flag to me is the rally. In terms of the rally, I still do not see a change of character type of the rally, which means that it's going to break out of the immediate down channel. This is very important. So far, in terms of the up wave, this is the up wave, is not on par. There's no good quality up wave, no aggressive up wave. All we have here is a mediocre up wave. We need to look at two aspects. First is that do we have quality demand? Do we have aggressive demand in order to push the price up? Second, how is the quality and also the aggressiveness in terms of the down wave? So this is very important. So far, the down wave is still dominating. We got relatively impulsive down wave, going down, going up, going down, going up, going down again. If you measure the wavelength, right, this is the down wave, there's another down wave. Certainly, this is larger than the up wave, the up wave. So far, the bear is dominating, the supply is dominating, and we see that there is increasing of the supply, not a good sign for the bull. Last week, we talked about the bullish scenario. I talked about this is a more likely scenario to happen for the bullish case because where we have this sort of the movement. So that should be on Tuesday, Monday. Yep. This spike is on Monday. Last Tuesday, we talked about a more bullish case to happen. And ideally, I want to see decreasing of the supply. And also, I expect it to test around 4,480 to about 4,500 if we can break out from here. But we also discussed a more unlikely scenario, which is the bearish case. And I mentioned that we could also see something bad happen because the war is still ongoing at the moment, the Israel versus the Hamas. That's what happened on Wednesday. Actually, on Wednesday is still not bad. This is Tuesday. So Tuesday is still relatively good, but on Wednesdays is violate everything. So Tuesday we still have a demand tail right here. On Wednesday we see that there's a breakdown here. So that changed everything, and then followed by a very quick movement to the downside. And also we discussed about the potential last wave down or the final flush right here. So at this point, although it looks relatively bearish, but if we look at the previous analog, in terms of the volatility, in terms of the magnitude, and in terms of the duration that is taking to drop about 9.8%, it's about 3 months. So that is much better than during the bear market in 2022. And if we look at the progress to the downside, so first we got a drop right here. So we got a break down, going down. That's the progress to the downside. Breakdown, going down. That's the progress to the downside. Right now, we got a breakdown here as well. Yesterday, there's actually a breakdown. Breakdown. Do we see a flow through to the downside? Not yet. This is still unfolding. What we have here is a decrease of the thrust to the downside from here to the second wave to the third. The third is merely the spring. If we see a bounce back up from here, if there's no follow through to the downside, like going back up because it's oversold to even 4,350 or 4,400, then that's a signal that the selling momentum is exhausted. And in terms of the level, that makes a lot of sense as well. Look at where S&P is at the moment. Here is the support zone. And although there is spike of the supply here, but it did not break down from this zone and then going down. So suggests that there's still presence of demand right at this zone. If we see a reversal from here, let's say if S&P can come in above 4280, then that is the first bullish sign that is going to have a rally, a relief rally is upcoming. But it needs to come in above 4280. If we could do that, means that it would need to take out the high from yesterday, going up, and then keep going up until it's reaching the access line, access level 4360. That's the immediate resistance level. And we do not want to see spike of the supply keep going up. If that's the case, then that will tally with the deteriorating of the market breadth, which is already a red flag at this point. We need to be watching out for that as well. For the bullish case, we don't want to see increasing of the supply while it's capping the up move to 4360 to 4400. If it keep attempt to break, but with spike of the volume, then that's not good at all. We need to be very cautious for that to switch it to relatively bearish view before to anticipate a crash of the market, like accelerating to the downside, if that's the case. But until that happens, we could see another attempt to go up. We want to see decrease of the supply and need to have more testing because this is increasing of the supply from here that need to be tested. It should take some more time. So not sure we still have a Christmas rally, but it will take more time for it to repair from now on because the failure happened at this point. Since Wednesday, Thursday, Friday, that's just break the structure. That's the S&P 500. But in terms of the longer term, this is still a very important level. So far, it's holding up well. But in terms of the market breadth or in terms of the market environment based on the stock screener, there's not many setup around. We need to wait for the right setup to pop up and to come to us rather than to force a setup. Right now, there's not much to do apart from monitoring how it will actually unfold. Unless you would like to trade a swing up, which is doable from here to here, because right now it's at the support level. This is a potential spring. Like I mentioned, if it could come in above 4280, then this is a setup. You can use any type of instrument. For example, E-mini is a very straightforward type, or the ETF SPY or the CFD index. Your stop loss should be somewhere around below the hammer, say 4199. And to anticipate at least a rally to test the access line, access level, 4360 and to about 4400. So that is a potential setup. And best, you could dive into the hourly time frame to look for better reward to risk. If you want to catch my latest videos, click on the subscribe button and the bell right now so that you get instant notification once I upload my latest video. If you want to check out my online courses, go to tradeprecise.com to find out how to profit consistently from any market without using complex indicator or understanding any financial statement, no matter you are trading or investing.